Hello, welcome back. I'm with David Graffalo, the CEO of Gold Royalty. David, good to see you.
Thanks for having me on, Peter.
No problem. Kick things off for those less familiar. Tell us about the company.
Sure. The company actually was founded just a little over 2 years ago. It was taken public back in March of 2021, initially with a portfolio of 18 royalties on our former parent company's assets, Gold Mining Inc. All development stage assets, about collectively 32 million ounces of gold equivalent, all within the Americas. And what we endeavored to do after the IPO, which was very successful, we raised $90 million US, we got very good valuation on the marketplace, was to use our currency to vastly diversify our portfolio, not just outside of the assets within gold mining, but also bringing in some near cash flowing assets, also add significant and critical mass into the portfolio as well. And that was very successful. We acquired Ely Gold, Golden Valley, Abitibi royalties as well as a number of other individual royalties and packages of royalties, and we've grown from 18 royalties initially to over 200 today.
Let's talk about your royalty portfolio at the moment, because what it looks like now, I wouldn't mind getting a bit of a clearer picture in terms of what's in cash flow, what the revenue is, and really what this looks like over the next 5 years in terms of your transitioning from a lot of construction and development stage assets that are coming online, and this company's transforming really. It's in a really good position. So if you don't mind, maybe run us through the actual portfolio.
So we have about 7 that are cash flowing currently, another 16 or 18 that are in development stage meaning in construction or at very late stage in terms of the feasibility and early stage construction. And so as a result, we're going to see compounded annual growth in our revenue over the next decade of 60% per annum. So we're going from what this year will be about $5 million of revenue to $50 to $60 million of revenue by the end of the decade. And that's unparalleled in the sector.
If we take a step back, can we talk about you and your background and really how did you get involved in this?
Well, my background is mine development and operation. Even though I'm a financial person by background, I've been involved in the construction of about 15 mines in my career. I've operated countless more, initially in a fairly junior position in met mining back in the 1990s. I was a CFO at Agnico Eagle for a dozen years through its formative years and when it was undertaking massive expansions. And then ran Hudbay for about 6 years on the copper side before I went to go run Gold Corp until its merger with Newmont. So I've come from that operating and mine development background, and what I'm seeing in the broader sector is the need for reinvestment back on the ground through exploration and mine development. It's been neglected for well over a decade now, and so I see us starting to turn as an industry from just harvesting to actually starting to invest back in the ground in that way. But we're doing that in an environment where inflation is deeply entrenched. And so I'm a big believer in gold. I'm a bull on the commodity, but what I don't want to be exposed to is the inflation that's inherent in our business right now. And so I think royalties provide the best of all worlds. It provides optimum leverage to what I think is going to be a rising gold price, but almost complete insulation from operating capital cost inflation.
Your revenue is based on the revenue of the mine, not the profit, right? So
yeah.
So maybe you can just touch on that and how it is a bit of a buffer to inflation.
Yeah, virtually all of our royalties are what you call top line royalties. So we get a percentage of the revenue. And we're also open to doing streams as well. But again, you're getting paid in kind in terms of the product that's produced at the mine. So it really doesn't matter what the margin is at the mine site, what happens to the operating capital costs. The beautiful thing about our 200 royalties is they're bought and paid for. We never have to put another dime into them. So we're not exposed to capital cost inflation, operating cost inflation. Not only that, but our operating partners, and there are about 75 of them that own those 200 underlying assets, are investing this year $200 million in exploration at the mine site. So we get that upside to the exploration without actually having to contribute to the exploration budget. So it really is the best of all worlds. And particularly in this, as I said, what's I think an entrenched inflationary cycle that's going to be here for many years to come.
Taking a step back from when we were talking about your background, you mentioned Agnico and a few others where it sounded like you had a lot of M&A experience then, and obviously what you've demonstrated since you've started Gold Royalty is M&A. In this inflationary environment that we're in with gold and sort of look at all the other royalty companies out there at the moment, how much more, I guess, scope is there to do the sort of deals that you have been doing? Is there many more out there that you think you can get your hands on?
Yeah, there's probably 10 too many companies in the space right now, and what informs that opinion is the fact that there really isn't a mid-tier in the sector. And when we started Gold Royalty and IPO'd it back in March of 2021, there were 5 more companies than there are today. So we've taken over 3 of them, and 2 others have disappeared into Sandstorm and now Triple Flag, and the acquisition of Mavericks recently. There's still scope for many, many more to consolidate. We need to create a mid-tier, a champion in the space. There are the category killers in the sector: Franco, Wheaton Precious Metals, Royal Gold, and those are massive blue chip companies. They're excellent businesses, but there's limited scope for them to grow. They're almost too big to meaningfully grow and add shareholder value. There's no individual royalty acquisition that any of those 3 companies can make that will move the needle for them. Whereas within the smaller end of the space, through consolidation, we can create critical mass very quickly. We can drive up our multiple, drive down our cost of capital, make us competitive. What's not there right now in the sector is that $5 billion market cap company that's big enough to matter to institutional investors and capture their imagination, but small enough to grow meaningfully.
This is, I assume, what you're planning for a mid-tier royalty gold company. You're talking about this 60% compound with your current revenue year on year, and it gets you to about 50, 60 million. That's with your organic growth, right? I assume, as most would, that more M&A would be on the table. So really, investors could be looking at this and thinking, well, that's the base case, but really with more M&A, there is a lot more scope for you to grow a lot quicker than what's already there.
Yeah, you're right. That is the base case. Our 60% of compounded annual growth is coming from our existing royalty portfolio. It's not wishful thinking. These are assets that are either producing currently or in various modes of construction and expansion. And they're being expanded and constructed by well-capitalized operating partners. So we have a high degree of comfort that we're going to be able to deliver on that. But M&A is not the only way we can grow. There is a baseline to our business that we grow organically. With Glenn Mullen in Quebec, Jerry Boffman in Nevada, we generate our own royalties through sweat equity. We stake exploration claims around existing mines, around existing deposits. We wait for the neighbors to knock on the door and say, we need that piece of property. And we say, great, we'll take back a royalty and an option payment and a work commitment. And that royalty is now created. 38 of our royalties came through that organic generation model. So that provides us a steady baseline of royalty generation for very low cost, virtually no cost, in fact. And then we'll continue to be active in picking up individual royalty opportunities. We've done that through project financing, for example, Monarch Resources and their Beaufort restart, through the acquisition of third-party royalties, as we did with Côté, and most recently the Nevada Gold Mines portfolio that brought Barrick and Newmont in as significant shareholders into the company. So really it's important for us to be able to grow through multiple dimensions.
What's the scope here? Obviously, including the name Gold Royalty, but what's the scope here to potentially diversify? Is that ever going to be on the cards in terms of commodity, or do you think precious metals is the only place for Gold Royalty?
Well, that could be awkward given the name, you're right. But no, there certainly is scope for diversification. And in fact, in the initial inaugural royalty portfolio we had, there was significant amounts of copper, a couple of copper gold porphyries that gold mining is developing currently. And I'm a bull on copper. I like having a bit of copper exposure. Right now we have about 95% exposure to gold. So there's some scope to be able to diversify, but I think it's generally in the context of buying a polymetallic deposit, where we're trying to buy our gold royalty, but we get some copper and zinc and silver along for the ride.
Let's take a step back and look at more of the macro environment, if you don't mind. Obviously, we've been in a pretty crazy gold environment. I'd say even over the last few weeks, we saw gold go down to around 1,600. We're now back over 1,700. As someone who has worked in this space for an incredibly long time and had a lot of success, what's your view in terms of the next 6 months or even 12 months of the gold space?
Well, this is an inflation cycle in many ways like what we saw in the 1970s. And I am old enough to remember it. I was in my teens and I remember lining up at gas stations and seeing empty grocery shelves and an oil embargo. All the things that we're kind of experiencing now, though the oil embargo today is self-imposed. Back in the 70s it was imposed on us by the Arab world. And so we're seeing a lot of the signs of inflation, supply chain bottlenecks that drove up the cost of living dramatically through the 70s and early 80s. And we had a central bank governor in Paul Volcker at the Federal Reserve who was intent on taming inflation. And we saw him jack rates to 20% when inflation headline numbers were 14 to 15%. The big difference between then and now is that now we have massive amounts of debt on a per capita basis that far exceed what we saw in the 70s. Debt to GDP in the late 70s, when Paul Volcker was raising interest rates, was only 100% globally. Today it's 350%. So what I would say is where Paul Volcker had the latitude to raise rates to tame inflation and raise rates nominally well above the headline numbers, there certainly isn't that kind of scope available to central bankers today, because it would very readily bankrupt governments for them to raise interest rates above where headline inflation numbers are. So what that tells me is there's going to be a grand pivot here. And I think the pretext for doing that will be softer labor markets. And what's changed also from the 1970s is central banks have a dual mandate now. It's not just to bring inflation to within a narrow band, but it's also to engender full employment. That's a big differentiator. And that means that they're going to have to pay attention to those labor markets. And when we start to see employment numbers start to soften, and they are starting to soften now. We're seeing massive layoffs in the tech sector, for example. We're going to see the central banks use that as a pretext to say, you know what, we're done with the tightening now. Or they may even pivot entirely and start to bring their interest rates down to make the fiscal situations of global governments more sustainable.
David, thank you for your time.
Thank you for your time.